It's great to have all of you here, and thank you for taking time to join us the day after a July 4th holiday weekend. So I just want to make a few comments before turning everything back over to Todd Jones, our Chief Investment Officer. First of all, I want to make sure everybody knows that if you're on here, obviously you listen to Market Matters, but the talking points that Todd puts out once a week on 2 Minutes with Todd every Monday are awesome. And they give everybody that tunes in and listens a quick update for the week on what's going on with the markets, things we're doing with the portfolios proactively. It's just a great source of information for you, the client, to be getting access to what our chief investment officer is saying. So I encourage you to tune into Market Matters in 2 Minutes with Todd. Market Matters are obviously monthly. So with regard to comments today, I want to talk a little bit about the news and what we're all seeing regarding the war in Ukraine, inflation and the Fed, and just the general decline in the market. I've mentioned this before during our updates, but there's a huge difference in digesting news and research and making appropriate, unemotional decisions rather than watching the news and being gripped by fear. I remember after 9/11, when we went into a deep recession, and many experts said that our economy would never recover and everyone was afraid to fly. I remember in 2009 when the Dow hit 6,600, and tons of experts were on CNBC saying the market was going much lower and most municipalities around the country would go bankrupt. These are all things that we've been through as investors and at Gratus and myself, and you're going to continue to hear this kind of talk. You're going to see many articles that say we are in for more downside volatility, and that may be true. But remember that doom and gloom is how the media makes money. The market will not feel good when it starts to turn to the upside. You know, we're not short-term investors. What's going to happen over the next 3 to 6 to 9 months? No one really knows. But I can tell you this, that the investments that our team are selecting for the portfolios and the long-term performance that Todd and his team have been able to deliver for our clients will be consistent over time. And so I want to try to get all of you to stay focused on that. Our investment team has done a great job delivering performance for a long time for our clients, and short-term downside with the market is actually part of investing. So what we're going through right now is unfortunately quite normal with the market. So there's some things that we cannot control. We can't control when the war in Ukraine ends, how our government responds to the war or inflation. We can't control that. And we certainly can't control in the short term how the markets react to it. But what we can control is the effort that we put as a firm into communications with you. We can control the effort we put into protecting you and making proactive decisions in the portfolio. And I can assure you our team is working on that every day. And most important, we can control not letting fear impact our behavior or our decision making. And that's the discipline that is required of our behavior as being advisors and running Gratus Capital. So I think, you know, where the market goes from here, it may go a little bit lower, and it may take time. You know, we got overextended on the upside at the end of last year for a long-term bull market, and a reset of valuations is totally normal when that happens, and that's what we're in the middle of right now. So what Todd and his team have done, action that we're taking, is we will be rebalancing portfolios. What that means is if a client had 50% of equities in their portfolio and that's dropped to 45% as a result of the market going down, we have discipline levels on the S&P 500 where we will be buying stocks and rebalancing the portfolio. It's important because it best positions the investor for maximum gain when the market does recover, which it will. So our advisors are on the phone with our clients every day, all day long, addressing their concerns, discussing the portfolios, readdressing the financial plans. And I strongly encourage you to revisit your portfolios, revisit your long-term financial plan, and stay focused on just that, the long term. We're 100% committed to you, and we are not going to let up, and we'll continue to do our best to keep open lines of communication as to actions that we're taking with the market and how we feel your portfolio is best set up for your personal goals. So again, I strongly encourage you to be having active conversations with your advisor about your financial plan, about your long-term asset allocation, to give you comfort during these times, which are actually normal, but it is part of investing to go through this. And thank you for your patience and your commitment to our firm. Todd, I turn it back over to you.
Very good. Thanks, Hank. And I forgot to remind everybody, if you do have any questions as we go along, please feel free to drop those into the chat feature of Zoom, and I'll grab those off and try to address those one at a time as they come through. So with that, we're going to kick off into the economic update. And, I would say we certainly are experiencing a lot of economic volatility at the moment with some of the wearing off of stimulus and a bit of a reacceleration that came out of COVID. That it does appear to be giving back a little bit, and that's just par for the course, I think. What you're seeing here, and I showed this last month as well, but it's always good to revisit this. So what you're seeing here on the screen is a view of both the services sector, which is there in purple, and the manufacturing sector, which is there in orange. Just for reference, any number that's above 50 means that the economy is in expansion. And so what you can see here is a pretty clear trend, certainly recovery from COVID, a little bit of a drawdown coming off the peak at the end of 21. And so now settling in more probably into that normalized range with both the manufacturing and the services sector. Definitely there is a bit of a drawdown or noticeable downtrend within the manufacturing sector. Something that we're watching very closely, of course. But I think we probably would be remiss to say that having a shallow recession likely would not be out of the cards here. And I think we've positioned appropriately in the case that would be an outcome or an occurrence. The other chart I showed maybe a couple of months ago was where we sit with commodity prices, because commodity prices have really been the boogeyman relating to why inflation has been so high in a lot of ways, particularly for the lower income spectrum, where housing is not as big of an item for them as it is for maybe some of us. But what you can see here is a picture of a few different indexes going back to and this chart starts at the beginning of 2022, by the way, so this is all recent info. The purple line, this is the energy sector, and the chart, the legend is right up here in the upper left. But the energy sector, you can see, has had a huge run this year, and this combines things like crude oil, Brent crude oil, natural gas, distillates, diesel, things of that nature, up on average in raw commodity price terms about 50% through the end of June. The broad commodity index, which combines all tradable commodities, is up about 21%. But interestingly, as I noted, maybe it was like the beginning or middle part of May, is that we started to notice that the commodity sectors of agriculture, which is the blue line here, that's things like grains, wheats, soft commodities, canola oil, things of that nature, and also the base metals, and that's things like copper, zinc, aluminum, have all really kind of tapered off as far as price appreciation. And so what is that telling us? Well, middle of this year or middle of the quarter, I guess you would say, things started to move a little bit lower. That should filter through to inflation. And I think that's the big issue at hand right now, as you all may know that have tuned in. We think that inflation is the big boogeyman for financial prices. And so the fact that we've got both the agriculture sector and the base metal sector now declining or flatlining in price appreciation is very positive from a future inflation expectation standpoint, because as you may remember, we don't believe that we'll be able to make a lot of progress, at least over the near term in the stock market, until inflation kind of cools off and heads back the other direction. So this is a very positive outlook or dynamic for commodity markets. Energy as well has taken a big hit recently. So as long as these kind of trend to this lower level over time, I think gives us comfort that inflation will likely start to cool off here sometime towards the back half of this year. And what does this mean for this? When do we hit below the 6% points that we've highlighted many times in the future or in the past? So what you see here is two charts or two lines. One is the month-over-month change in the CPI, going back, back to the first part of 2021. This is the trailing 12-month CPI. So with the May reading, it showed that inflation increased 8.56% on a year-over-year basis. That's a very high. It's 40-year high going back to the 70s. Trailing 12 month, or the rolling 12 month, is this orange line here. And what you can see is it takes a little bit of time to turn the cruise ship because it's an average. But with inflation having ticked back up a little bit in May, what this does to our forecast is that it just extends out the time with which we'll get back below the 6% level in the trailing 12-month inflation rate. And this is important because, as we've showed a few times before, markets, or financial markets, both the stock market and the bond market, do not like inflation above 6%. It's tolerable if it's somewhere between 2 to 6, and there's varying degrees to that statement. So it's not meant to be a be-all end-all. But really, what some of the data would suggest in our research shows that when the average trailing 12-month of inflation is below 6, that's when you start to get positive returns out of both the stock market and the bond market, because it's just a more manageable number. So what this does is it pushes out the time we get to the 6th level from maybe early in Q1 to the latter part of Q1, maybe into the first part of Q2. So we'll definitely be keeping an eye on how this evolves over time. And I do think it's important to focus on, when there's bearish sentiment, as Hank pointed out, you could throw a rock at any Wall Street strategist and they all say the same thing at the moment, which is very negative, lots longer to go, so on and so forth. But I do think, and it's important to remember, that markets are a discounting mechanism, which means that they look 6 to 12 months into the future. And because they do that, today's prices are reflecting information that will come in economic data 6 to 12 months from now. So, you roll the clock out, call it 9 months. We're at the end of Q1 of 23. And if we're in, Q1 of 23, that's their expectation is that, inflation will have moved to a lower level. We don't know exactly what level that is, but I think it's just important to understand it's a forward-looking index. But that being the case, so we have to start to consider, okay, what could go right? We know everything that can go wrong, and a lot of it's already played out. So the news is today's headline is yesterday's news as far as the markets go. But what could go right? And this is really important to keep in mind, because there are already some leading markets that have turned up and stayed up. And I'll show you that in just a moment. But what could go right? Well, first is we've got this extremely negative investor sentiment that could reverse course typically on a dime, that can propel markets much, much higher, particularly over the short term as sentiment reverses. Because we're at, sometimes all-time low level readings for investor sentiment. Another positive dynamic would be a cessation of the conflict in the Ukraine. We don't know exactly what the motivations are going to be for that cessation, but who knows? There could be some sort of compromise pact that is agreed upon between both sides or all sides that turns down the temperature, if you will, on the conflict, and that would be a big positive for markets. Another one would be if inflation declines faster than expected. Now, more recently, that hasn't been the case. It's actually stayed up kind of in the sticky level of between 8 and 8.5%. But if for some reason there are certain areas of the economy that do decelerate faster than expected, then that could be a really big positive catalyst for the markets, because that would also allow the Federal Reserve to stop being as restrictive to financial conditions, meaning raising interest rates, as they currently are right now. And then finally, there could be some sort of compromise tax bill on some of these areas, like the SALT tax or capital gains rates, corporate tax rates. These are all being kicked around right now. Global minimum tax, all these things, having some clarity around taxes is usually a good thing. And so markets tend to respond pretty favorably to any of these types of reversals. So we definitely want to make sure we're keeping an eye on what could go right, because we're kind of at that point right now where everybody's so negative that it's not going to take much to turn the market around. And rarely are we going to know exactly what that one thing is going to be that's going to turn the market around. So that leads us into the investment outlook for 22. And we have changed a couple of things. More recently, we did upgrade it, at least on the research agenda, our view of looking at the small cap space. I'll show you why in just a moment here. The small cap space has really been beaten up from a valuation standpoint, particularly relative to the S&P. And so that more attractive starting point just gets us more interested. We haven't made any decisions on whether or not and how much to enter into small cap, but that valuation is looking more attractive by the day as the market declines. And we are almost at a level, as you'll see in a moment, where small caps are trading for less than 10 times their forward earnings. And that tends to be a pretty good entry point. We still have a bit of a negative outlook for emerging markets. Nothing really to speak on there. We haven't had exposure to since the early part of the year. And that's been, I think, additive for sure. In developed markets, we definitely downgraded developed markets, just thinking that there could be some additional knock-on effects with a prolonged war in Eastern Europe. And we just want to make sure we're minimizing our exposure, not eliminating it completely, but minimizing it whenever possible. What we did do, though, more recently was upgraded our view on municipal bonds. Those have, in the bond space, tended to trade more on supply and demand versus the treasury or corporate market. And those yields, particularly when looking at them from an after-tax perspective, have gotten very competitive with almost anything out there in the bond world at the moment, even high yield. So we're currently looking at or have been shifting a little bit towards that direction across all of our accounts. And then what really hasn't changed, which has been additive this year, has been our preference for alternative assets, whether they be liquid or private. And that's been, certainly in the context of a stock market that's down close to 20% or maybe a little bit more today, in a bond market that's down 10, alternatives have definitely filled that gap between stocks and bonds and buffered some of that downside. Now let's just take a look at some of the portfolio themes that we're currently working off of right now from an investment committee standpoint. Certainly I think this continues to hold true, move forward, but with caution, where we've got a trust in our process, but not taking any sort of outsized risks in areas we don't need to. And that's really looking at categories that would be a little bit more on the speculative side that at the moment for us are unattractive. And that would be things like on the fixed income side, still want to maintain a core position on that front, having no high yield or preferred stock or speculative positions on the fixed income side. And then on the equity side, we still continue to remain exclusively large cap at the moment, with a thought that we might be looking at small cap here in the near future. I did just want to point out that transition phases for markets, they just take time to work through. As Hank mentioned, the 2000 analog is not a bad one to be looking at, and I'll show you another period of time that we're looking at as well that might have some inference as to where we're going. But the early 2000s took a number of years to work out of. So from the peak of March of 2000 to about the middle of 2002 is when the market finally found its bottom. So about 2 years. The mid 40s, as we'll see in a moment, that took a little bit longer, but somewhere in between those two is kind of what we're thinking at the moment. Definitely want to make sure we all understand that there are better opportunities that lie ahead as prices go down. That just creates better starting points for a lot of different asset categories, particularly those that may have been beaten up or ones that we want exposure to. And the good news is that we don't have to have exposure to those if we don't want. It's only going to be on our terms. And so exercising that discipline is going to be really important, because the better our starting point, the better the forward-looking return gets for that asset category. And then finally, I just wanted to point out, as I mentioned, alternatives have been holding up well relative, particularly to both what's going on in the stock market and the bond market. On the liquid side, yes, they are still down for the year, no question about it. But there are positions we've added, I would say, within the last 6 to 8 weeks that have had a meaningfully positive or demonstrably positive impact to the alternative sleeve. That's really supporting return in that category. And I'll show you an example of that here at the end. So let's take a look at the picture for the stock market. You can see here on the screen, year-to-date view of a number of different categories. We've got the legend up here as well as on the side here. But through June 30th, the S&P is down 20.5%. International developed markets are down 21.5%. Small cap down 23.5%, almost 24%. And then interestingly, China has bounced off its bottom only to be down around 7%. And this Chinese bounce, I think, is really significant. And I'll tell you why here in just a minute. Apologies for the blur here. This is a great chart that I could not replicate out of Fidelity, but it shows two different time periods. The black line is March of 2019 to where we are right now. Actually, this is as of June 1st or May 26th. And then the pink line is the S&P or the reconstructed S&P starting in 1943 through 1949. And the point I wanted to make here is that there are a lot of similarities to these two time periods, certainly coming off a war and a reindustrialization of the economy. Retooling is exactly, I think, the way it was phrased. Higher inflation rates coming as a result of the war that occurred. And what it took a few years for this inflation and retooling, reindustrialization to work its way through the system. And the stock markets were basically in a sideways range for the better part of about 3 years after there was an initial drawdown. And so, not to say that we're going to spend 3 years in a sideways market. That's not our expectation. But somewhere I think in this neighborhood is anywhere from 1 to 3 years is probably within the realm of expectation. The important point, though, is that as we move through this chop, there will be opportunities to rebalance, to add to new positions, to sell overpriced positions, because we're already starting to see quite a bit of divergence within the markets. Just look at what's happened with the energy equity sector versus maybe the technology sector. That's, I think, one of the widest chasms between those two sectors that has been on the books for decades. And I think it currently stands at about 60% point differential. So what we're saying is, just be on the lookout for opportunities, because this certainly is turning into, I think, a single stock or a stock pickers market, more so than any other time that I've seen in the last 12 years. So this is I think a useful analog, because it's rhyming quite a bit with conditions that existed out of the 40s versus what we just came out of. This is a chart I showed on Market Matters that Hank was referencing, but I think it's worth showing again because there's a lot of great data here. And again, if you do want to get a copy of this slide deck, just let us or your advisor know, and we'll send it to you after this. But there's two different charts, both from Goldman Sachs here, that are worth pointing out. One is that these are S&P returns following a 20% decline, which is where we currently are, going back to starting in 1950. And what you'll notice is the average decline is roughly 33% peak to trough. Now that does pull in a lot of time periods that maybe might not be analogous. So some of the 70s or 87 might not be as analogous as to where we are today. But that notwithstanding, what's also important is this other column right here, which shows if we were in a recession or not. And if we were in a recession, then the average return during that time frame is about negative 36% or so for the following 12 months, or peak to trough, I'm sorry. However, if we're not in a recession or in a shallow recession, which is, I think, actually a prior base cases I was just talking to one of our clients about, given a variety of factors, if we're not in a full economic recession, then the average decline is about 26%, which is not too far off from where we got a few weeks ago. Furthermore, the speed with which we've gotten to this drawdown, which this is as of June 15th or June 16th, but we did touch down 24%, which is right at the trough there. What you can see is relative to every other 20% drawdown back to the 1950s, the current one has been the quickest to get down to this level over this time frame. So we definitely don't want to be selective with the data per se, but it is instructive to say that we've come down quite a bit. The market has probably overshot a little bit more recently to the downside. And that does suggest that if we do have this condition, which I think we're in, which is more of a technical recession than a full-on contagion recession like the types of 2008 or even like the 70s inflation scare that we had, that it's likely going to be a bit more of a mild recession. And now this is the really interesting chart that I've been talking to the team about, and some of my colleagues as well. Looking for some of those leading indicators and what kind of led us out of previous periods, not to include the financial GFC, the Great Financial Crisis. And I think what's really interesting is that China has become much more of an important player on the global scene. Their economy has grown immensely. since, basically reindustrializing in our early 2000s. But more recently, they're the number 2 economy in the world behind the US. And so just the sheer size of their economy demands we at least pay attention to it. And what you see here is the time period between June of 2008 to June of 2009. This is, of course, encapsulating almost fully the financial crisis. And what you'll notice is in the yellow line or the orange line here, the Chinese market actually bottomed about 5 months in advance of the S&P finding its floor in March of 2009. There were a variety of reasons for that, no question. There are certainly some nuances and differences, but China's market is rapidly maturing and becoming more of an institutional place for capital. Of course, we don't have any exposure there, but I think what this shows is that there are some markets that, for one reason or another, can be looked at as leading indicators, and China could potentially be one of those. Obviously, it's one part of the mosaic, but there was about a 5-month lag between the Chinese bottom, when it bottomed out first, and March of 2009 when the US market bottomed out. So what does this picture look like today? Believe it or not, it's actually a very similar picture, which we showed initially on that first slide, but notice what happened to the Chinese market. After selling off much harder into this growth slowdown, if you will, into the latter part of March, they bottomed in March and then have been finding a little bit of a bottom ever since then, never making a new low. Now, that's not to say that it can't happen, but it is following maybe a little bit of a similar pattern, whereas the S&P is still kind of working its way lower, trying to find that floor. Are we at the bottom yet? Potentially, we don't know exactly, but that's why we'll have to use some data to suggest where we are within that evolution. And so, if we use the 5-month time frame, that would suggest that August might be about the time when the U.S. market finally bottoms, at least using this indicator. Now, as you heard me say earlier, inflation is likely not to move below that 6% level until maybe Q1 of next year. So, we'll have to split the difference potentially on that. But I think it'd be very encouraging if the Chinese market found its way higher, even to make it maybe a break even by the end of the year. That'd be very encouraging to think that the second largest economy in the world found its bottom, that the US and other developed markets potentially might not be too far behind. What I was talking about with small cap earlier, I think is perfectly encapsulated in this chart right here. Now, again, we would probably maybe take more of an active approach to the space. We don't know quite yet. We're still evaluating. But what you see on the screen, this is all data through June 30, so it's live data, are a number of different equity indexes. Some of the main ones we like to look at, S&P right here in the middle. Believe it or not, the S&P current forward price to earnings ratio, which is just a valuation ratio, is at 15.8. The 20-year average is 15.4. Now, again, this is the forward P, which means analysts are looking out 12 months and assessing what those earnings might look like. And you can see actually the S&P is trading right a little bit on top of its forward PE. So, no substantial valuation argument necessarily. It's just that we have now worked off some of that excess valuation we started the year off with, and now we're at a more average multiple, which is actually very encouraging because derating has occurred quite a bit. But if you notice over here in the small cap space, the current forward PE for earnings for small companies is 11.2. I can't remember at a point in time in the last 20 years when the forward PE for small cap has been that low. I have to look back and see if when the last time we were at this level was. But the 20-year average, I think more importantly, currently stands at around that 16.7 times, which means that small caps on current day's prices are trading at about a 1/3 discount to their 20-year average. Now, again, this is not to say that this is a trigger for us to do anything. It's really just more kicking off the research effort. Mid-cap is not far behind at about, it's at a 30% discount or so, 29% discount to its 20-year average. But it's, becoming really attractive. And I think the final point I'd make on this slide is if we can find attractive companies in the small and mid-cap space that are at 11 times earnings, their forward estimates, why would we even bother with something like emerging markets that are also trading at the exact same level when we're getting currency and political risk? International developed, that's more of a rifle shot approach where we're using active approaches there. So can have a lot better outcomes in the index. But this is just, I think, a great slide to show how far we've come in such a short period of time. And so this is currently an area on our research list. Fixed income is something that's been a very brutal ride. I mean, this is, you can see here through the end of June, as of June 30th, the our aggregate bond index was down about 10%. That's the fastest move down to 10% that we've had, I think, since the early 1900s. Municipal bonds, interestingly, and this appears to be a well-placed shift we were starting to make middle of last quarter, which was municipal bonds have been holding up quite a bit better. And I think that dynamic is going to continue to hold because we're actually entering a seasonally light period for issuance for municipal bonds that will, in my opinion, just be supportive for price. But really, what's been dragging down the bond market? Well, it's really been the combination of inflation and inflation expectations having risen quite a bit since the beginning of the year, as well as interest rate sensitivity to certain bond indexes. Now, all of these indexes right here, this is the orange is the high yield index, has had a brutal ride, down 17% for the year. Preferred stock index down, call it 16.5. Then emerging market debt down 21. Just all reinforce the idea that these are really more equity proxies than they are bond proxies, if you ask me. And so that therefore, if we're going to even consider these for our bond portfolio, we need substantially higher yields on these starting yields. Otherwise, we're just taking on way too much risk. And I'll share with you what those levels are here in just a minute. This is a picture of all government bonds, by the way. And it shows you, again, the purple line is the aggregate bond index. The orange line is the TIPS, or the Treasury Inflation Protected Securities Index. And the TLT, this is the 20+ year bond ETF, down a pretty staggering 21%. Now, that more recently, that's moved to the upside as recession fears have become more acute in the bond market. But this is, I think, again, just to suggest that we want to be very specific with the risks that we're taking within our bond portfolio. And we definitely don't want to be extending duration, or at least into a economic situation that has a lot of inflation baked into it. Also, I included tips on here to say that even if we did think that inflation was coming, it was still a negative outcome because the duration of this TIPS or TIP index pulled the portfolio down 11%, which was a bit staggering. So we still favor, short intermediate term bonds. We have been swapping out some bond funds for individual bonds in some cases, and making some shifts within our municipal portfolios that we're using, moving from active mutual funds in some cases to active ETFs. So definitely want to make sure we're being mindful of tax loss harvesting opportunities, but also some higher yields we can find in high quality bonds. And then finally, relating to fixed income, I just wanted to share with you where we sat with bond yields across the spectrum of bonds, starting 331, which is this red hash line, and where we ended the quarter, which is the dark blue line. And so you can see across a variety of categories, there was a pretty broad re-rating, which means that yields rose and bond prices fell. And that was acutely felt within the high yield space, emerging market debt space, and investment grade corporate bond space. These are all ETFs, so some experience will be a little bit different than others, so just keep that in mind. But with this orange box, as why I decided to include it up here, these would probably be the two that might fall onto the research list at some point if we got to higher yields. But the thing is that these likely won't fall into our research agenda until we get at least up to the 8% level, or maybe even higher in the case of emerging market bonds, because we just have to realize we're taking on more risks and therefore we should be compensated appropriately. So anyway, I just wanted to make sure we outlined or identified where some of those trigger points might be in fixed income, and I think that the net is a lot higher. And then finally, on the alternative side, I just wanted to share with you an example of some of the strategies we've been adding to accounts over the course of starting in early Q2 towards the end. And what you see here in the purple line is an example of what they call a trend following strategy. Now, this is an ETF. It's the KFA Mount Lucas trend following ETF. This index actually, interestingly, goes back to the early 80s. So there's a broad range of data that we can look at for this. But the reason I just wanted to highlight this is that one of the things that I've outlined in previous market matters that we've been looking at, that we now finally have some exposure to, is what they call trend following strategies. And I think in the August market matters, we'll go through a little bit longer of an explainer as to what trend following really encompasses, but it's strategies that go long and short a variety of different financial instruments based on the underlying trend of those securities. So right now, what's really been working for them is being long things like energy and short things like equities, and you pair those returns together, which is how you've had this really big divergence in performance. So again, we don't own this in our portfolios. I just wanted to, this is an example of a trend following strategy that has made its way into the majority of our accounts, and one that we think will likely have a pretty good run, assuming that we have continued levels of stock and bond market volatility. And then finally, just some key takeaways. I know we're kind of up against the clock here, so I wanted to make sure we got to the end here before any questions. A reminder is drop the questions you have into the chat feature, if you will, and I'll try to grab those or follow up with you after. But we still remain in a stocks over bonds positioning or favoritism, despite the fact that we've had negative performance for the first half of 2022. Forward-looking returns, in bonds are pretty, they're not easy to forecast, but they're based on starting yield. And I think there still is some potential risk for longer term bonds that we think having a little bit higher equity allocation on average, of course, understanding that more volatility is going to come along with that is going to be the right answer. And active strategies where they make sense. We still favor alternative strategies over bonds this year. I think in particular has been pretty demonstrative of how alternative strategies can perform, certainly in relationship to what you could have owned in the bond portfolio and the stock portfolio. So those continue to be very good diversifiers. And on the private side, those strategies in some cases that we're looking at have done pretty well as well. And then finally, we are expected to see more volatility into, I think, later to 22 into 23, and that just means a lot of up and down. So portfolio management and discipline, as Hank mentioned, not getting shook out of positions unnecessarily is going to be really critical to managing in this environment, but also taking advantage of opportunities when they get really attractive is going to be a really key leg on which we're going to build some portfolio return on, because if we can add just for example, if we can add things like high yield bonds or at a 10+% yield, or REITs, for example, at maybe an 8% yield, those tend to be pretty good starting points for future returns in those categories. And so a lot of negativity has already been priced in to get to those levels, and so that therefore we want to make sure we're acting when the time is right. I'm going to pause it there just to see if there are any questions. I just wanted to reiterate that if there are any topics that you would like us to touch on, or any guests that we've had previously on, feel free to shoot me an email or message your advisor directly, and we'll certainly put together what we can to help bring more insights to those topics. But I did want to say thank you for taking the time to spend with us today. I know this is very challenging periods for markets. We certainly think there are brighter horizons on the future, and then we just got to get through to the other side here. And we look forward to speaking with you again sometime in August. Thanks so much.